Welcome to EVA India Insights, our podcast series where we explore the trends shaping businesses today. I'm Pallavi, your host for today, and in this episode, we explore secondary transactions in Indian startups and the challenge common belief that they happen at discount. Drawing from the latest report, many of these deals are actually priced in line with the primary rounds. To understand more on this, we're joined by Naveen Vora, leader of valuation, modeling, and economics at EVA India, who will be sharing all his perspectives on what this means for founders and investors. Hi, Naveen. A very warm welcome to you, and thanks for joining us today.
Hi, Pallavi. Thank you for inviting me.
Thank you, Naveen. So, Naveen, to begin with the very basic questions, what are secondary transactions in Indian startups?
Okay, so there are two types of transactions. One is primary and the other is secondary. So if a startup is raising money and it wants money into its books for its own expansion and working, that would be a primary transaction. However, if an early set of investors who bought into the company earlier, or founders or employees who get ESOPs. So if they are selling their securities, which could be equity or convertible preference shares, that is called secondary. So as in an early stage in a startup, you'll have only primaries mostly because you're just investing into the company. And as the startup matures, you'll have a set of investors who invested earlier who may want to get out now, get some liquidity, monetize their stake, and then you will have secondaries also.
Thank you, Naveen. Now that we've established what secondary transactions are, could you also tell us why fundamentally secondaries are at discount?
Yeah, okay. So basically, we should understand that unlike traditional companies, which take their funding through pure equity shares, uh, in case of startups, most of the funding is done through convertible preference shares. So what it basically means is that there are certain set of rights given to investors in each round, and two of them are very critical, very important for us. One is the liquidation preference, and second is the anti-dilution right. So what these two rights establish is in a way to establish a floor value for the investors. Basically, it means that if there's a valuation drop in the company, I will at least get the money that I have invested in. So this gives it a set of rights which are not there typically in a pure equity. Now, what happens is as you do a primary, you will get a fresh set of rights, a superior rights compared to a previous round. So ideally, from a theoretical perspective, you would say that, look, I would want to invest in a superior right than the previous round, which had somewhat inferior liquidation preference, a lower liquidation preference. And hence, fundamentally, there can be a discount in a secondary to a primary round or at the same time.
Thank you, Naveen. Now, bringing back to the reference of our latest study, which shows that most of the secondary transactions happen at or near primary valuations. So, according to you, what does this reveal about the market maturity and the investors' confidence?
Right. So I think, as we said, this right that we have liquidation preference is more a downside protection right that I will get at least my money back. But suppose the company is doing very well, if it is growing very fast, then I don't need that. My money is anyway, my valuation is anyway increasing. And especially if the company is highly in demand and you think that, this company would go for an IPO, so if it sort of does a primary and investors are very keen to sort of buy into it, and they think that yes, I mean in the near future the valuations will increase only, and maybe there will be a liquidity event also, then there would not be any discount in a secondary compared to a primary because you think that the valuations will go up and this round has this rights don't have much value. Also, what happens is as the companies mature, their requirement for primary funds keeps going down because initially they need a lot of funds because they are expanding, they initially are developing the market, they are investing, do not have profits. But as they mature, they become somewhat more profitable, the cash flow generation increases. So the primary requirement goes down, but if the secondaries are available and if investors are interested, there's more demand than supply. So that also causes the uh, discount to vanish. There's a There's also a converse scenario where you think that, if the company, has a binary outcome, either it'll succeed or it'll completely fail. So if it completely fails, even then the rights that convertible preference shares have don't have any value. So that is another reason why in some cases, in very few cases, you won't have a value for discount for secondaries. But largely it is because, companies have done well, there's a lot of demand from investors, and, even the investors who invested think that the liquidity event is close by, so why should they sell at a discount? So these are some of the factors causing this lack of discount in India.
Thank you, Naveen. Now, in cases where discounts do occur, so what are the key factors that are driving them and why are they generally limited?
Right. So, see what drives firstly discount is, as we discussed, rights are there. And also, if I'm an early stage investor and, I've invested for a few years now, maybe my fund life is getting over, or I have a liquidity requirement. Suppose I'm a founder, I need some liquidity, or I'm a employee who got some ESOP shares who need some liquidity. And I don't think a liquidity event like an IPO is very close by. I may be happy to sell even at a discount because that is the only way I will get liquidity. And anyway, I have got good returns from the company. My IRR have been achieved. And most importantly, this is really a discount also for liquidity. So unlike listed companies, these are unlisted shares. So there may be a limited pool of investors who are interested to buy the company's shares. So they would buy it only if it is available at some discount to the primary. So I think these are some situations where we think, okay, maybe the company is not going for an IPO for 3, 4 years, maybe because it's still loss making, it's still growing, it may take time, or maybe the conditions in the capital markets are not conducive for an IPO for such a company. In this case, and the investor has a requirement to for some the investor selling investor, whether it's a founder or an employee or a previous round investor, has a requirement for some liquidity. In that case, you will have some discount. So as we found in some situations, we do get discounts.
What are the broader implications of these trends for founders, existing investors, and the new entrants looking at the Indian startup ecosystem?
Right. So a few implications are there. So if I'm a employee or a founder, the fact that there is no systemic discount. So, there could be a perception that always there's a discount, but that's not there in India, which is a good thing because what it means to a founder or an employee is that if the company performs well, at a time when I want liquidity, I can get it without any discount. I don't have to pay a penalty for selling my shares in the market. So that's a very good aspect for anybody who's an early stage, investor or who's a uh, even an employee or founder. Sometimes they have a liquidity need. What they are showing is if I'm performing, the market will at least support getting me a fair value for my shares. For the new investors, I think this is a kind of a vote of confidence in the company. So when you're coming in into the new, coming in new into a company, I mean, you don't know the company very well, and you have some information asymmetry. But if you see that the early shareholders they are willing to sell only at without any discount, that shows that yes, they are confident about the company and its management and its future prospects. So that gives you a further confidence about the company. So overall, I would say that if most of the transactions are happening at same value as primary, secondary transaction and primary, there is no discount. That shows that yeah, the ecosystem has evolved very well, and primaries and secondaries are priced similarly. There's no penalty being put for liquidity. It shows that there is fair amount of liquidity in the market, and that's a good sign for the development of startup financing.
Thank you, Naveen. And that brings us to the end of this episode. Thank you so much once again for joining us and sharing all your perspectives.
Thank you, Pallavi.
Thank you. And to all our listeners, we hope you found this discussion helpful and understand much better the evolving dynamics of the secondary transaction in India's startup ecosystem. Thanks for listening. Until next time, this is Pallavi signing off.